2 years ago, the Maharlika Investment Fund was signed into law, a landmark piece of legislation that sparked both excitement and apprehension across the nation. The signing ceremony itself was a momentous occasion, filled with promises of a brighter economic future for the Philippines. It was envisioned as a powerful tool, promising to channel the nation's wealth into prosperity and sustainable growth, aiming to uplift the lives of Filipinos through strategic investments. The fund was touted as a game changer, capable of unlocking new opportunities and propelling the country towards greater economic heights. Its creation marked the Philippines' first foray into the world of sovereign wealth funds, establishing the nation's very first such fund, with the primary goal of investing in critical infrastructure projects, securing a stable and sustainable energy supply, bolstering the agricultural sector, and accelerating digital transformation across various sectors to ensure long-term returns and global competitiveness. However, unlike the sovereign wealth funds of other countries, which are typically funded by surplus revenues from natural resources or trade, Maharlika's initial capital was primarily sourced from government-owned banks, specifically Land Bank and the Development Bank of the Philippines, a decision that ignited immediate controversy and public debate. Concerns were raised over the potential risks of diverting crucial resources away from the bank's core mandates of supporting agriculture and development projects. While proponents passionately defended it as a long overdue and necessary tool for driving national development and economic progress, critics voiced serious worries about potential financial risks, the need for utmost transparency in its operations, and the responsible and accountable use of public funds entrusted to the fund. To manage the fund's investments and operations, the Maharlika Investment Corporation was established, accompanied by strong assurances of professional management and independent oversight to safeguard its integrity. Yet even from its inception, fundamental questions persisted about its very necessity, its complex organizational structure, and the potential risks it posed to the nation's financial stability, casting a long shadow over the fund's future. As we look back on the Maharlika Investment Fund's beginnings, the intense debate surrounding its origins remains absolutely central to understanding the challenges and opportunities it faces today. After a year of meticulous preparation, countless meetings, and rigorous due diligence, Maharlika's first major strategic move into the infrastructure sector was acquiring a significant stake in the National Grid Corporation of the Philippines. This acquisition wasn't just a financial transaction. It was a calculated step to secure a foothold in a critical industry. This marked a strategic entry into the energy sector, a sector vital for the nation's growth and development. The move signaled Maharlika's intent to play a pivotal role in shaping the country's energy landscape. Supporters lauded it as a prudent and necessary investment in a vital utility, emphasizing the importance of modernizing and strengthening the nation's power grid. They believed it would lead to greater efficiency and reliability in energy distribution. However, critics voiced concerns, arguing that it simply shifted public wealth into private hands without necessarily spurring new development or ensuring tangible benefits for the average citizen. They questioned the long-term impact on energy prices and accessibility. The fund's next step was riskier, a move that raised eyebrows and sparked further debate about its investment philosophy. It involved a $76 million bridge loan to Makilala Mining Company, a relatively unknown player in the mining industry. This loan was specifically earmarked for financing crucial feasibility studies related to a potentially large-scale mining project, a project with both significant promise and inherent risks. This bold decision signaled Maharlika's willingness to back high-risk, early-stage ventures that traditional investors might shy away from. It demonstrated a higher risk appetite than initially anticipated. The fund was clearly aiming for substantial future returns from the exploitation of untapped natural resources, betting on the potential of the mining project to generate significant wealth. Proponents passionately argued that this was precisely the fund's intended purpose, unlocking the value of national assets and driving economic development through strategic investments. Conversely, critics issued stark warnings about the inherent dangers of exposing public money to the unpredictable and often volatile nature of speculative industries like mining. They feared potential losses and the misuse of public funds. The stark contrast between these two initial investments, one representing a stable, established utility and the other a highly speculative mining operation, significantly intensified the ongoing debate over Maharlika's overall investment strategy, its risk tolerance, and its ultimate goals. These early decisions, particularly the investment in the mining sector, firmly set the tone for ongoing public scrutiny, media coverage, and political controversy surrounding the Maharlika investment fund. Maharlika soon looked beyond domestic investments, announcing a landmark partnership with Thailand's CP Group to create a $1 billion private equity fund focused on Philippine agriculture. The goal: modernize farming, improve supply chains, and introduce advanced technologies, leveraging CP Group's expertise. The government hailed this as a vote of confidence and a chance to bring in foreign capital and know-how. By co-investing with a global giant, Maharlika aimed to de-risk its agricultural ventures and maximize both financial and social impact. Yet, questions arose about whether the partnership would truly benefit smallholder farmers or primarily serve corporate interests. Observers called for transparency to ensure inclusive growth and prevent marginalization of local players. The success of this venture hinges on balancing profit with genuine national development. As we moved into mid-2025, the leadership at the Maharlika Investment Fund began to signal a significant acceleration in their investment strategy. The fund was targeting the completion of at least 3 new major investments before the year drew to a close. These weren't just minor adjustments. They represented a bold step forward in deploying capital. This ambitious goal had the potential of raising the total commitments of the fund to approximately $37 billion, a substantial increase that would demonstrate the fund's growing influence in the Philippine economy. One anticipated move involved forging a strategic partnership focused on transportation and logistics infrastructure. This partnership aimed to directly address the persistent infrastructure bottlenecks that have long hampered economic growth, with the ultimate goal of significantly boosting the nation's overall economic competitiveness. Beyond transportation, other planned investments were expected to target key sectors such as renewable energy sources, improvements to water infrastructure, and the expansion of digitalization initiatives across the country. These diverse investments were intended to further diversify the fund's portfolio, reducing risk and maximizing potential returns across a range of industries. This carefully considered mix of both stable, long-term projects and more transformative, high-growth ventures was specifically designed to effectively manage risk, all while actively pursuing ambitious growth targets that would benefit the Philippine economy as a whole. The fund's managers expressed hope that this forward-looking and proactive agenda would not only build positive momentum, but also effectively counter the persistent criticism regarding the perceived slow pace of action. However, it was understood that every new investment undertaken by the fund would inevitably face intense scrutiny from various stakeholders. This scrutiny would center on issues of transparency in decision-making, the alignment of investments with clearly defined national priorities, and the demonstration of tangible public benefit. Therefore, the coming months represented a critical period for the Maharlika Investment Fund to definitively prove its worth and demonstrate its positive impact. The pressure was undeniably on to deliver concrete and measurable results that would ultimately justify the fund's existence and its role in shaping the future of the Philippine economy. Despite Maharlika's progress, criticism from economists and academics remains strong. Many argue the fund's goals are unclear, developmental or stabilizing, making it vulnerable to political influence and mismanagement. A key critique: Maharlika was created without surplus revenue, instead reallocating scarce public resources from government banks and the budget. Critics warn this diverts funds from proven priorities like education and healthcare, with no guarantee of better returns. Concerns also persist about governance and independence, and the risk of political interference. Some question whether Maharlika adds value beyond existing mechanisms like public-private partnerships. The burden remains on the fund's proponents to prove it delivers net benefits to the economy. Maharlika's legality faces a direct challenge in the Supreme Court, where lawmakers have petitioned to declare the fund unconstitutional. The case centers on public accountability, arguing that entrusting vast sums to an independent board lacks sufficient oversight. Petitioners claim Congress unlawfully delegated its power of the purse and forced government banks to divert funds against their mandates. As of July 2025, the Supreme Court has yet to rule, leaving Maharlika's future uncertain. The fund continues to operate under this legal cloud, with the possibility of dissolution or vindication hanging in the balance. A ruling against Maharlika could force its closure and return of capital. A favorable decision would not end public skepticism. The outcome will have far-reaching implications for the fund and the country's approach to public investment. Until then, uncertainty prevails. The impact of Maharlika on state banks remains a major concern. Land Bank and DBP's mandated contributions weaken their ability to support farmers, small businesses, and development projects. The IMF recently urged the government to restore these banks' capital, warning that the transfer made them more vulnerable to shocks. This validates early warnings from local experts about the risks of draining bank resources for the fund. Restoring capital would require more public money, creating a dilemma between supporting Maharlika and funding direct public services. The situation highlights the real costs and trade-offs of the fund's creation. The fate of these banks and the sectors they serve remains closely tied to Maharlika's future. 2 years in, has Maharlika delivered results? Supporters point to strategic investments in energy, mining, and agriculture as signs of progress and long-term vision. They argue it's too early for major returns, emphasizing that the fund is planting seeds for future generations. Critics, however, see little concrete benefit for ordinary Filipinos, questioning whether investments in existing utilities or speculative mining projects create real value. The partnership with CP Group has yet to yield visible outcomes. Skeptics argue that billions funneled into Maharlika could have been used for immediate needs like education or healthcare. The debate over its effectiveness remains unresolved. For now, Maharlika's tangible impact is still a matter of perspective. The fund's ability to justify its existence is still on trial. In mid-2025, Maharlika's story is still unfolding, marked by bold ambition and deep controversy. The fund has made high-profile investments and forged international partnerships, projecting an image of dynamism and strategic vision. Yet it remains dogged by legal challenges, economic doubts, and warnings from global institutions. The central tension: long-term vision versus urgent national needs. Is Maharlika a leap toward prosperity, or a costly distraction from pressing problems? Its legacy will be measured not by promises, but by real economic outcomes, new infrastructure, higher incomes, and sustainable returns. For now, it stands as one of the administration's boldest and most debated experiments. Whether it becomes a masterstroke or a cautionary tale remains an open question for the Philippines.